Thank you all for coming back this afternoon. My name is Doug Almond. With Wolfram Schlenker, I co-direct the Center on Environmental and Economic Policy at Columbia. On behalf of Columbia and SEPA, I would like to thank the New York Fed for co-organizing and co-hosting today's conference. I have the pleasure now to introduce our keynote speaker and also the speaker for our subsequent fireside chat. I will start with Joe Stiglitz. Joe Stiglitz, as you know, served as the chief economist at the World Bank. He was chairman of the Council of Economic Advisors under President Clinton. In 2001, he was awarded the Nobel Prize for his work on the economics of information. Happily for Columbia, in 2001, he moved and joined our faculty. Something you may not know about Joe Stiglitz is that soon after arriving at Columbia, he started the Sustainable Development PhD program some 20 years ago. And so this path-breaking program combines economics with natural sciences and engineering at the doctoral level. And that is a very innovative program to this day, and it's one that's been very successful. And we're seeing some of that terrific work on today's program. This morning's paper by Rachel Young, and this afternoon's paper that Anna Popp will present, both represent that integration of economics with hard sciences. So to summarize, Joe, who I think many of you already know well, has been a true trailblazer in a number of areas, but that also includes environmental economics. Now, I'd also like to introduce someone else who does not really need any introduction. John Williams has served since 2018 as a president of the New York Fed. He's the 11th president of the New York Fed. He oversees a staff of 3,000, carrying out New York Fed's mission to make the U.S. economy stronger and the financial system more stable for all segments of society. Previously, he served for 7 years as president of the San Francisco Fed. He's obviously an expert in macroeconomic and monetary policy. His published work often focuses on the natural rate of interest. He has famously quipped that he has a passion for R star. So if you're a grad student, you might think that's funny. He oversees a stellar economics research program here at the Fed that likewise also has a group studying the effect of the environment on macroeconomic stability. So we've seen some of that work from this group in this morning's paper by Seltzer et al. On banks' exposure to climate transition risks. I encourage you also to check out the Liberty Street Economics blog, which features insights from New York Fed economists that combine research with policy. This blog was launched in 2011 and is named after the street on which those newbies today entered from 33 Liberty Street. So thank you again to the Fed, and thank you to John in particular for his support of our annual conference between the Fed and Columbia. We will continue to focus on major and evolving topics in environmental economics and how they relate to policy. This is the second iteration of this collaboration. Next year's will be up at Columbia, so get ready to take a long subway train way, way, way uptown. Finally, a brief housekeeping note. This afternoon's session is not being live streamed, as you probably know, but it is being recorded, and therefore all remarks are on the record. If the audience has time for questions at the end, please do give your name and affiliation. So with that, please join me in welcoming our keynote speaker, Professor Joseph Stiglitz.
Well, it's a real pleasure to be here and to help participate in this joint venture with the Fed, and to talk on this topic. Thank you for the introduction, Doug. But may not have mentioned is that I was on the second lead author of the second IPCC report, which was the first report that introduced economics into the IPCC. And the first topic I'm going to talk about is related to what our insights were then and what we saw coming. There were some things that we didn't say because we didn't as strongly as we should, because the evidence at that point was not as strong. For instance, the term global warming really doesn't capture what is going on. It's really climate change. It's hard to believe, but at that time, some people said 1.5, 2 degrees, you know, a little warmer, it'd actually be a little nicer in Newfoundland. We could maybe go swimming in Newfoundland. And so the idea of 1.5, 2 degrees, people actually wrote papers, believe it or not, showing that cities that were a little warmer weren't that much worse off. So there was a lot of poo-pooing of the significance of this. But what we realized then, and which is since been really clear, and especially by the events of the last 2 years, is that climate change includes not only a change in average degree, it's the way we summarize it, but it's variability and droughts, floods, hurricanes, extreme weather events, which make large parts of the world uninhabitable. That actually raising the level of heat has actually having devastating effects, let alone looking at some of the other consequences. Sea level rise will make a third of Bangladesh uninhabitable, and that's going to generate migration pressures. The Sahel is expanding, and in the face of rapid population growth, which I don't understand fully, in Africa, with the reduction in the supply of land, is going to make that, again, a very serious problem. So what we're talking about here is a much more profound effect on our societies than just global warming. It's really a very major change. So the first general question I want to address, and I'll hopefully talk about it briefly, is how is it that the central model within American economics, and I'll explain why I use that word American economics, which is the integrated assessment model, says it's optimal to fry. That is to say, it's optimal to have 3.5 degrees or 3 degrees. They've now revised it to 2.8 degrees. But the scientific community is convinced that anything above 2 degrees represents a risk that's not worth taking. And the general consensus is 2 degrees is too high. It ought to be much closer to 1.5 degrees. And where between that is really a question of what's attainable, but clearly the risk increased in a very nonlinear way with temperature as a measure of overall climate change. So that's a really interesting question. And as I pose it to my students, who do you think is right? The global international scientific community or American economists? Now, I say American economists because when I travel to Europe, the reaction is, you guys in America are really peculiar. You have created your American economics culture. We don't understand it, and we don't pay any attention to it. So, when I'm in Europe, I'm preaching to the converted, and they say, "Oh yeah, what else do you have to say?" And here, when I give the talk, nobody wants to listen. So I hope this is a receptive audience where I have at least the possibility of converting some of you into reason. So what is the essential issue that the international community is focused on? It's risk. They say, what is the language? They say it's too risky to go beyond 2 degrees. You look at the integrated assessment models as they've been developed. Eventually they will get better, and they are getting better. I'll come back to that at the end of this part of the talk. But where is risk? There is no attention to risk. 0. Can you believe it? The central problem is one of risk, and the economists in America don't even incorporate any risk in their models. Now, of course, this is very sensitive to me because I spent most of my life talking about risk, so they've ignored me. So, but I don't take it personally. It is, why did they do it? Because it's easier to model. Yeah, but the responsibility of modelers is to do what they can to incorporate the essential problem. And if you throw out the essential problem, there is a risk that what you say is irrelevant. So they modeled it as many of you who've engaged in these integrated assessment models know, IEM, in the question of intertemporal maximization. Sacrifice today for benefits tomorrow. And the benefits, of course, are a world that will be livable. So we know a little bit about the benefits, and then the question is, what are the costs? And they begin with a model that they tweak in a very small way. The standard model was the Ramsey model, and the tweak was to put in the environment, climate change. But the Ramsey model is a really bad model for analyzing the economy, what I say, a real-world economy. It's had a disastrous effect in macroeconomics. And when I first got the invitation, I didn't realize it was just a climate conference, and I was going to talk a little bit about how the dangers of central banks becoming overly reliant on DSGE models, which are based on a little tweak of the Ramsey model and have been proven disastrous for the American economy. They didn't predict the 2008 crisis, and I could talk about why they are so bad. But I won't bore you with that, but I just want you, for those of you who are in banking, to remember that in the back, or macro, remember every criticism I make of these models is also true, of the climate models is also true with those macro models. So I hope it makes you uneasy with what your macroeconomics models are saying. But in the case of climate change, the fundamental problem is that it assumes perfectly rational individuals who live infinitely long. I haven't done regressions on the subject, but my casual observation, which I feel much more strongly as I get old, is that people are finitely lived. It's very easy to show that models with overlapping generations with long-lived individuals is markedly different from a dynastic model with infinitely lived individuals. So it just is a very bad model for studying the long run. It assumes a certain kind of stationarity, and in the context of climate change, the assumption of stationarity is just such a bad assumption. Just think about one of the major issues. The population of the world has increased about threefold in the last 70 years. And that has meant that we were living within our planetary boundaries when Bob Solow wrote his basic growth paper, certainly when Ramsey wrote his paper, but we are not living in our planetary boundaries now. And so you combine a change in population and a change in per capita income, and you see that what was possible one time is clearly not the other. And so any of those long-run models, I don't want to criticize Ramsey because in his world, it might have been made sense, but not in the world that we live in today. So, and to me, one of the most important mistakes beyond technical issues like they got the damage function wrong and they got a lot of the functional analysis wrong, but beyond that, they assume no market failures other than the environmental market failure. But again, I don't take it personally. My own work has been concerned about credit rationing, absence of risk markets, a whole array, and these are consequential. Let me, maybe let me one more. I'll mention there were no distribution effects. Ramsey was a representative Asian, a single person, and we know that models where there are a distribution behave very differently from those where a representative Asian model doesn't capture what is going on, certainly from a welfare point of view, but even from a descriptive point of view. So, given all these assumptions, if you go through the analysis, Nick Stern and I have a paper where we've done this fairly carefully. The outcome of this is that the IAMs systematically underestimate the benefits and overestimate the cost of a climate transition. And they underestimate the benefits because partly because they don't include things like health. Again, more recent models begin to do that, but these health benefits turn out to be enormous and actually outweigh many of the other physical objects. But they also underestimate the benefits because of the way you weigh the future. And discounting is essential here. Under President Trump, the discount rate that became official in cost-benefit analysis in the US government was increased to 7%. Well, 7% discount rate means that every 10 years, the benefits are cut in half. The value of a benefit is cut in half. So spending $1 is only worthwhile today if you get $2 of benefits in the future of 10 years. Well, you do that in a climate change in the long run, you talk about 40 years, it's like 50 years, 3 cents. You're willing to pay 3 cents to save $1. Basically, the future becomes irrelevant. And so you might as well roast. But if you use 0 or 1%, you get a very different result. Now, in an overlap in a model with generational model, the question is, should you discount future generations? And Ramsey actually said, and the moral value is no. Why should For instance, why should future generations be weighed less than the current generation? If you lived in a dynastic, you believed the Ramsey model, you say that the appropriate number would, your first hypothesis would be the intertemporal rate of substitution. And that's the real interest rate. And that's been, the safe real interest rate's been about 1.5%. Not the 7%. That's a very different result. But once you introduce risk, how do you think about it? Well, investments in climate change are a kind of insurance policy. They pay off when climate change is particularly costly. And what do we know about insurance policies? Insurance. People pay a premium. So what does that mean, the appropriate discount rate? Ken Arrow and I wrote a paper back as part of our 1995 IPCC report. I asked him to come and write a chapter for that report. And the interest rate should be significantly lower than the 1.5%. It could even be negative because you're getting an insurance premium. So that's obviously very different from the way if you use a riskless model with calibrated, it turns out that there's an anomaly between their safe real rate of interest of 1.5% and the marginal return on capital, which is about 7%, which they don't explain. And there's an easy explanation. It has to do with a whole series of risk market failures and risk. But they've ignored risk, and they've ignored the other market failures. So internally, the models, even the way they think about it, is intellectually inconsistent. So what I hope I've explained why those models underestimate the benefits. They also overestimate the cost. Because one of the reasons, I mean, for instance, it would pay most people in the United States to, oh, am I talking too long? No, okay. It would pay most people in the United States to get a solar panel. Why don't they? Well, or it would pay most people to buy an electric car. They don't, because the interest rates that they face are 20, 30%. That's what they pay on their credit cards. But if you gave if you gave loans at 3% or 4%, 5%, they would do it. So one of my proposals is that the U.S. Treasury ought to lend money to anybody at 1% over the relevant U.S. borrowing rate, collect it with their taxes, make it perfectly safe then, for green investments. And that would, but that's an example of correcting a market failure and lowering the cost and getting a lot of green investments. So the IEMs, I hope none of you have wasted your time doing this. The IEMs, I hope you haven't wasted your time studying those models. But if you have, I hope I purged these ideas from your mind. Okay, I should say, just to be friendly, that the IEM models have improved. They've responded to some of the criticisms. But two things are interesting. As they respond to these various criticisms, the recommendations of what the optimal rate of frying varies enormously. So they become an unreliable tool. You know, what is the government supposed to do? Which model, which set of assumptions? So if it could be anywhere from 1.5 degrees to 4 degrees, it's not a very reliable tool. The second thing is, as they start introducing better assumptions about distribution, damage functions, They don't do risk, but they often do scenario analysis and better discounting. They get numbers that are much more like the scientific communities. So they have been moving more into, you might say, an area of where they become reasonable. But they remain, I think, not a good tool for analyzing this. And I can talk, if we have more time, what they ought to be doing and what those of you who engage in this kind of enterprise, the kind of models you should be using. Okay, so the second part of the talk I want to talk is more concerned with finance, the role of finance and climate change, and how to think about it, including my advice to the central banks. So I want to begin by, what are the risks that are relevant? And I like to think about there being 4 separate but some related risks that one ought to be thinking about. There is the direct damage, the hurricanes, the water rising. This is not the appropriate place to make this joke, but I'll make it anyway. I used to say that, I often say that one of the good things about climate change is that Wall Street will be underwater. But the backside of that is Wall Street will make us pay for their moving to New Jersey. So we'll bear the cost in any case. So even that is a societal cost. And by the way, that's these costs of the physical damage in the United States has been enormous. It's been between 1% and 2% almost every year. And that's money that could have gone into productive investment. And what are we doing? We're spending it repairing, getting back to where we were. And this is a reminder that GDP is not a good measure. Something I spend a lot of my time, talking about. It's not a good measure because it includes the repair damage. It doesn't tell you that, in fact, all you're doing is getting back to where you were. So some people say, oh, GDP went up after the hurricane. Well, that's because they had to spend all that money. It doesn't, and after all that repair, they're just back to where they were. So there's the direct damage cost, which takes many different forms. We see it in the wildfires and and deaths. We can talk about that. And then there's a second thing is that's related is the reduction of the value of assets. So that's the anticipation of the change in the value. And one aspect of the reduction in the value of assets is fossil fuel assets. And all the other stranded assets that, all the electric generators that are based on fossil fuels, the cars. Some people here may own a car that is an internal combustion engine. You probably haven't realized it, but you're taking a loss in that value, and hopefully you will move quickly to electric vehicles. So there are big asset value stranded assets. Now, the simple models that we use, going back to what would be a good IAM, not the IAM I described, but a good macro model, describes what is going on in terms of stationary stochastic processes. That's what economists love to use. But one of the things about climate change made it very clear is it's a non-stationary process that we don't fully understand. And sometimes we use the word deep uncertainty of how we respond to this. Because there is that deep uncertainty, our standard modeling techniques may not be adequate for describing what is going on, and may not be adequate for capturing how markets will respond. I only have a few minutes, so let me talk about the second aspect of risk, and that's the probably in many ways for the markets more important, and that's the transitional risk. So what I just described would be risk that would be faced in a rational market that was working perfectly well. But that's not the world that we live in. And because of that, there are some additional risks that I want to highlight in making the transition to the green economy. Now, I happen to believe, in my mind, there is no doubt that climate change is real. So, you could ask me the question that was posed to David Malpass, the president of the World Bank, and he hesitated to answer. I'll answer the question, is climate change real? Yes, it is real. And I think it will be realized in the not too distant future by every country that we have to do something about it. And, but the transition is obviously not going smoothly. There are a lot of climate change deniers. Many countries are dragging their feet and politically getting optimal policies is impossible. Getting reasonable policies is difficult. Well, what are some of the implications of that? The first is that assets are being mispriced. If you don't fully, and there's more and more documentation of this. When I say assets, I mean like real estate assets. If Florida, large parts of Florida are going to be underwater, a lot of that real estate is not going to be worth much, especially beachfront property. And in other places you can buy a little bit land a little bit higher up. In Florida, I'm not sure that there is any place you can go. So that is going to have really difficult, great difficulties. You won't be able to get mortgages, and that's going to have a lot. Now, think about large weather events are imposing huge costs on our insurance industry. Insurance industry, again, a reflection of imperfect capital markets. In our models, the risk should be dissipated over the entire globe. Not a big deal. A hurricane in Florida is 0.0001% of global GDP. Not hard to absorb. That's not the reality. The risk of Florida hurricane is felt disproportionately by a few companies. And when they get hit, they stop issuing insurance. And if you can't have insurance, what happens to the mortgage market? And then what happens to the price of assets? So there is a dynamic here of transitional risk on the pricing of real estate assets that we've not really worked out well. Interesting side point is that the market value, as I say, doesn't really reflect these risks. And there's some interesting studies, PhDs that have been done at Columbia, where people have looked at NOAA data and see whether the extent to which new NOAA data gets integrated into pricing. And not surprisingly, not very well. Better in Democratic areas than in Republican areas. So that people who believe in climate change respond more than those who don't believe in climate change. The second set of mispricing are all the fossil fuel assets, all the stranded assets. And it's very clear that, again, that the companies have not been fully priced, coal companies, and so forth. So again, that represents a transitional risk. The second category of risk is a political risk, because our rules and regulations are very important in determining how firms and households behave, and there's a certain, shall I say, erratic response. In a two-party system, if one party believes in climate change, the other doesn't, the outcomes of elections can have very big consequences. But that means there's a risk. And the question is to what extent those risks get reflected in market assets, the market prices. Finally, let me say, a central bank, government, needs to be concerned not just with the individual risk, but that's important when all individuals are affected, but with systemic risk. And we saw in 2008 the consequences of the mispricing of a small fraction of our economy. Subprime mortgages were mispriced. And they were mispriced for not that long, for about 6 years. And then suddenly, people woke up and realized that people who have no income can't pay mortgages. You might say, shouldn't they have known that? Wasn't it rational? But now people believing in rational expectations and all that said, oh, they must somehow, they'll find the money somehow. To me, it was crazy. But they woke up, and what happened when they woke up in 2006 and 2007? We had a global financial crisis that originated from a mispricing in a small part of the US economy. Well, what I see is mispricing of real estate assets and fossil fuel assets, defining that in a very broad way, globally. And we live in a globally integrated economy. And that means we face an enormous amount of systemic risk. I can't tell you how much. That's a question really that has to be studied. I think there's a lot of uncertainty about the degree of that risk. It's network models of the kind that a lot of people have finally begun working on are the only way you can study these. These are complex networks, and I don't think they've yet fully absorbed all the nature of the interactions between the financial and the real system. But these are networks which are both have to integrate the financial markets and the real markets. But that is what I view as a real public good that central banks and governments need to focus on. Sometimes you hear, and I've heard it from some senators and congressmen, central banks shouldn't focus on climate because that's a long-run thing, and central banks should be focusing on the short run. But the point is, we're always living in the short run. And the one thing about financial markets is, while they're very imperfect, they do integrate the future. We don't know when they're going to do it, and we know they're not going to do it perfectly. Sometimes they over-integrate the future. They get overly concerned. So we shouldn't believe in there being, quote, rational expectations. That's not the right way to think about it. But that at some point they are likely to wake up and say, golly, there is such a thing as climate change, and change the value of assets in a dramatic way, which will have global financial consequences. So even though the long run, climate change is with us for the long run, it is, I think, a part of the mandate of the central bank focusing on financial stability and economic stability to try to make assessments of that climate risk. So with that, why don't we join and have a conversation?
Thank you so much, Joe, for joining us, sharing your views. I'm looking forward to our conversation on many of the same themes. I will tell you, I don't know if people know this, but I was a student of Joe's at Stanford when I did my econ PhD in first year macro. And this talk was very much like that course. First, it starts with what's wrong with everything you're being taught elsewhere. And then you spend the next, we were a quarter system, next 10 weeks learning how to think about things right. And that's, I think, exactly what you're saying to us. So the first question I have, I guess, let me start with this one is, you know, this insurance market issue, which you highlighted, the fact that people can't even get homeowners or fire insurance in some parts of the country. This is something you talked about 33 years ago when I was a first-year grad student, and I took the notes of everything about how imperfect information, market failures, not only lead to a mispricing of assets, but can actually lead to markets or prices not existing, the market disappearing. So talk a little bit more, maybe to help people understand, why is it, would it be, with the uncertainty and the imperfect information in these segments, that we're just seeing people saying, I don't want to insure?
Yeah, so I mean, that's very inconsistent with perfect markets, obviously. People are willing to pay, as I mentioned before, more than the actuarial value, and yet there's nobody offering it. And you know, part of the work that I did with asymmetric information was to say, well, one of the problems is if you know more about the risk than the other side knows, if you're willing to buy from me, I'm not willing to sell to you. Mm-hmm. And so insurance is an area that's particularly prone to market not existing because of these asymmetries. You know, there are every detail of geography or every detail of behavior. There is that asymmetry of information that leads to non-existence of markets. But the way so that's the you might say part of the theoretical frame. Since I taught that course, I spent a lot of time in Washington and engaged in policy discussions. I've become much more convinced of, you might call it, institutional failure. Things that ought to exist don't exist for reasons I can't explain very well. That we just, insurance markets in general are not diversifying the risk in the way you would have thought. And in the case of these insurance markets, there's reinsurance markets, so some of the insurance is shifted to like Swiss Re. And the really interesting aspect of this is these reinsurance markets are very sensitive to climate change. Mm-hmm. They're doing a lot of work on it. So they're part of the more informed, you might say. And because they're more informed, they don't want to sell insurance because they know the risk is larger. So if people don't really appreciate the risk, they won't be willing to pay the premium that Swiss Re says this is really where the demand is. Now, part of it is this deep uncertainty, where you don't have, in life insurance, you have a probability distribution that you can look at the probability of people dying at different ages. Even there, because of there's deep uncertainty because we don't know about extending life. And that's one of the reasons why an important insurance market that we would have expected to exist, annuity markets, are very bad. Because they say, what happens if somebody innovates and everybody lives longer than we hope, than we planned? And, and therefore, they demand a very high compensation, but the individual says, I don't believe that people are going to live that long. And so annuity markets, which are, sort of things that affect us individually, don't exist. And that has actually a very big effect on financial markets more broadly.
Well, one of the things that when I was listening to you talk about, the deep uncertainty about climate issues, I'm reminded in monetary policy, when it's in the central banking world, we often talk about the uncertainty of the economy, the uncertainty about how our tools affect the economy. But when I look at or listen to you and read some of these papers, it's like orders of magnitude greater. First of all, as you pointed out, we're talking about decades and decades, not just trying to figure out what happens over the next 6 months. We're trying to understand what's going to happen over decades. And one of the key things that we talk about in monetary policy is the uncertainty about the effect of our instruments on the economy, whether it's raising interest rates or things like that. But here, this seems to be a really big source of uncertainty too, right? How do the changes in taxes or regulations affect the achievement of the goals in terms of climate change? So how do you, first of all, think about that, this instrument uncertainty, if you will, and the other forms of uncertainty? And kind of how does that make you think about the right way to think about how policy should be designed in terms of goals or things?
Yeah, so this relates to something I didn't have a chance to talk about, but in a world in which there's only one market failure, like the integrated assessment model, the only market failure is climate. We correct the climate, then we're back in the nirvana. Mm-hmm. There's a simple instrument that we can use to get back to nirvana, and that's a price. And economists love price interventions, and so that leads people to say the optimal policy is a carbon tax. That's not true once you leave that world. And as you point out, there's lots of instrument uncertainty. And there's a famous paper that a classmate of mine, the late Marty Weitzman, where he had a particular model where you had to choose either a price or a quantity, and there were shifting demand and supply curves. And if you chose a price, because of the shifting curves, you weren't sure about what the quantity was going to be. But if you chose a quantity, you weren't sure what the associated market value benefits, the shadow price, you might say, was. And then he said, in the case where you have to choose one or the other, what was better? And what he showed, not surprisingly, was that there are a wide range of circumstances where choosing a quantity is better than choosing a price. So in this context, where this instrument uncertainty gets translated, it most easily can be seen in the following. Let's say that you're not sure how a price intervention is going to translate into firms polluting or not polluting. And you have very good information, knowledge, about what the level of carbon emissions we can survive at. So that if you get more emissions than this, the world falls apart. Take an extreme case. Everything's fine until you hit that limit, very nonlinear, and then it falls apart, okay? So that's extreme. We don't want to go beyond 2 degrees. Well, then it turns out that the optimal policy is to try to focus on the quantity, restrict quantities. You say, we don't, the danger of going beyond that quantity is too much, and the mistake in the price, the benefit is we've already focused on that. So that says we have to make judgments, and a lot of people in the environmental community believe very strongly in quantity measures because they think that's really, the increment of uncertainty is too large. One example that we're experiencing right now is the IRA, the Inflation Reduction Act, where we used a price instrument, a tax credit, to induce people to take green measures. Many provisions of the IRA were suboptimal in domestic content, but at least it got us moving in the green direction. So this part of the provision was estimated as costing $270 billion by the CBO. A few months ago, Brookings estimated the cost at over $1 trillion. They have made a mistake by a factor, the CBO by a factor of 4. And when I travel around the world, other countries are saying that we're getting firms from other countries to move to the United States because the benefits are so generous. They're talking about $1.5 trillion. That is what their estimates are. So that's an example of instrument uncertainty. We adopted an instrument, we thought it was going to be this magnitude, has a lot bigger effect. Now, in a dynamic model, things are more complicated because we're constantly revising either the prices or the quantities. So Weitzman analysis is not quite precisely, and it has to be thought through somewhat differently in terms of how you adapt. Mm-hmm. And there haven't been actually as good models doing that as there should be. But the general view that, from a theoretical point of view, you want constantly revised, nonlinear price schedules. And from a practical point of view, you often are faced with these price versus quantity discretely adjusted and, at intervals, and intervals long enough that lead me to lean a little bit more on the quantity side than the price side. Or the quantity is a regulatory side. Let's do more, and to me, there was a lot of anti-regulation view of regulations are inefficient, are hard to administer. And my view is sometimes, yes, but the price system, a carbon tax, is not that easy. And regulations like no fossil fuel electric generating plants and no internal carbon engines, very easy. We can tell what a fossil fuel electric generating plant looks like. There's no halfway in between. So I think this rhetoric about regulations being expensive and inefficient is overblown.
So, and one of the things that I'm curious about how it's related to that is also having clarity for people to make decisions. Like if you're a person deciding to put panels on your roof, or if you're a business thinking about how should I be investing, having that understanding of what's the rules of, and kind of how that works, so I can do my long run planning. How does that fit into?
Well, exactly. We tend, as economists, to underestimate the role of the cost of decision making, mm-hmm. and the complexity of decision making, and it's real, and that. If you just, one area where that clarity has made a very big difference is in innovation. There was an old joke about we have the emission standards for automobiles, and we've been raising them over time. And the joke was that when we raised it, the difference between American and Japanese car makers is that every time we raised it, the American car makers would run to their lawyers and lobbyists to get the government to change it. And Japan, they would run to their engineers to get them to make sure that they satisfied it. And so it was the view that clarity of saying we're going to get to an attainable CAFE standard, emissions, really did motivate innovation. And we did a lot of work when you were a graduate student, and I continue on this issue of endogenous innovation. Innovation just doesn't happen. It's a result of purposeful activity directed right now, whereas a lot of our innovation is making a better advertising engine in Silicon Valley, so people buy more things that they don't want to buy, wouldn't otherwise buy. You say, from a societal point of view, that's not the optimal way of allocating scarce research resources. Other research is creating more unskilled unemployment by saving labor. But what is the thing that we really ought to be working on is saving the planet. And that means more energy efficiency, carbon reductions in agriculture, new transportation systems, so forth. How to build better buildings. And all of that is incentivized by having clear standards of where you're going. And we've had enormous success in reducing the cost of renewable energy. And that's really been transformative.
So one of the things you said at the beginning is all the failings of the existing models. We're not going to do the DSGE models today. We'll bring you back, Joe, and you can bring all of our macro team and hear that. But one of the things, like I said, when I was in your class, is you then said, well, what are the models we should be studying? And you went through, the various asymmetric information models and things like that. But for climate, and we have a lot of people who are doing their research or PhDs or people here in the Fed doing research on that. What do you think? I guess I have two questions. So what do you think is the state of the art? What's the best kind of models you see today? And if you could have a wish list, like what future researchers or researchers today could develop in their climate models, what would you think is the most important things to have? Now, I'm going to give you check the first thing, which is having risk in there. So that's the number one on your list.
And market failures.
Market failure.
There are both macro and micro. Right. And I think, better micro is really important. How to save on energy, save on carbon emissions. And understanding, we were just talking about the nature of endogenous innovation, what kinds of incentives are, how do behavioral economics, how do people mind get framed around saving energy? One of the things, our food consumption is a major source of carbon emissions, and most of us know that having a vegetarian diet or a vegan diet has much fewer emissions associated with it than beef. Well, how do we get both young people and old people to switch their diet? I wish something would happen to me. But I think I've been successful with my children and even more with my grandchildren. So I feel that, that there is a societal transformation going on, and trying to understand how that transformation goes on, which is a behavioral economics. But, and I think they're, my children, grandchildren who are more on that vegetarian, vegan side, they're just as happy eating, probably happier than I am, will live longer. So I know it's the right thing in many ways. So I don't feel, it's a zero cost example of lowering emissions with essentially zero cost, something left out of the integrated assessment models totally. So those are just some of the topics. Two other areas, let me say. I mentioned one, which is network models, because the systemic properties, particularly for a central bank, are really important. And trying to understand the linkages and how that system works is really important. One of the other areas that I find very interesting, the level of detail that one can do today in integrating real climate, like hurricane models and data from NOAA with economic models, which we couldn't do, before modern computers. I think that's an example of where we can get better modeling at a really and insights at a micro level, and be able to get empirical results about how climate is affecting particular communities.
Right. When I think about this from perspective of a central bank or government, you have the obvious issues of risk in the financial system or breakdowns in availability of, say, insurance or financial services. You think about the macroeconomic or the economic effects, but for here in New York, it's the local effects of climate on our economy, jobs, and then you have, of course, the regional and global, because as you said, these are global. When I think about the systemic risk, just to respond to your comment about central banks, I completely agree that when you think about central banks, financial stability is actually our original mandate going back 100 years. And you think about systemic risks more generally, whether, as you mentioned in the before the global financial crisis, or other sources about spillovers and using things like network models. I think it's really important. It's also the reason why there is a distinction between micro and macro. I mean, some people think, well, micro and macro are kind of, macro is just micro scaled up, but it actually isn't, right? It's a very different kind of mindset of how you're thinking about the interconnectedness of things.
Yeah, and there's one aspect of this maybe I should emphasize, which is the significant micro and macro externalities. Climate is all about externality, but there are also financial market externalities that we don't normally fully take into account. If one firm goes bankrupt, it has effects on its creditors, and anybody linked with it. Even if a real firm goes bankrupt, it's both its suppliers and its demanders. And if you had a complete set of risk contracts, they would have integrated that externality. But we don't have anywhere near, loan contracts are really very simple. There may be a couple contingency clauses, but very few contingency clauses. So, because in the absence of those contingency clauses, there can be a very big externality. And that's why, just one of the reasons why a representative agent model or a representative bank model doesn't work. You really need to have a model where you have a theory model where you have the units interacting. And what adds to the complexity of this is that how that network, this is what we already know from research, but there's a lot more. we know that the behavior of the network as a whole is very different if it's symmetric or asymmetric. You know, if it's a one large firm with a periphery, you know, how you structure that network makes a very big difference. And if you look across countries, there are very big differences. We have a lot more banks than most European countries have, which have 3 or 4, and those networks are very different. Those are all the micro externalities, and then there's a set of macroeconomic externalities that we see when we saw it in the pandemic. If one sector is affected very strongly, like the service sector, it spills over on other sectors in a way that, again, that's not fully integrated into any price analysis. So one of my big criticism of DSGE and much of existing macro is that it's too aggregative. You know, aggregation is useful up to a point, but a lot of the shocks in our economy, you know, when you have an aggregate shock that affects everybody symmetrically, that's one thing. But if you have shocks, like a lot of our shocks, like the pandemic, the war, Russian invasion of Ukraine, that affects different industries differently, and almost every shock, that's true. Real estate sector may be affected more than other sectors. That means that you will lose some critical information by using an aggregate model. And then the modeling issue is, how can I get a parsimonious, maybe 2-sector, 3-sector? And it may have to, you may have to have flexibility and say, okay, that model of 2-sector worked in that shock, but now I'm gonna have to construct a 2-sector model where it's the service sector versus the non-service sector.
Yeah, I mean, this is the challenge we always face, is you want the parsimony so people can actually understand what's going on. You write down a 5,000 sector model with, you know, billions of people, and nobody actually understands what's going on, and having different models for different situations. I will just say, I'll defend the macro for 1 second before we give you, I know we're running low, but you know, so Doug made the comment about R star, but one of the things is in that research is we actually have a non-stationary model. The natural rate of interest is a non-stationary variable. The growth rate of the economy is non-stationary. And the first thing is, it's very hard to estimate non-stationary things. You still need to do it, but it's very hard. And the second is the uncertainty around it is enormous relative to the uncertainty in the stationary process. These are just kind of facts of the statistical nature of this, but I think it's an important thing to remember. Like you said, if we're looking at non-stationary processes like climate change, we have to understand that means, just not because we're bad at what we do. It means there's a great deal of uncertainty of understanding the state that we're in, and uncertainty about all the things we talked about earlier. I think that's just, it's an important difference between stationary and non-stationary models that can build on what you already said.
Yeah, and one of the other aspects of that is...
Oh, this is where we get really wonky, by the way, just in case you were wondering what we're doing.
but yes, the willingness to revise because you're getting more information. So, you know, to say, look, I thought this is the way the world was going, it turns out not to be true. Right. And so that means you have to have more of an openness to revision. And the second thing I think, where I think I'm not sure they've always done the right thing, is a analysis of the asymmetric consequences of different mistakes. Mm-hmm. That, to put it in a different, you know, back in the macro, having interest rate a little bit too high versus a little bit too low, by the same amount, one could have much more cost than the other. One could be more easily correctable than the others. So, in a linear model, everything looks symmetric. And if you linearize it, you feel good. You know your target, you have a quadratic loss function, everything is fine. But in a nonlinear world, even relatively small changes can have very asymmetric effects, different hysteresis effects. And I think one has to be very conscious of, there's a difference. We know that somebody who's pushed into unemployment has long-run consequences that are very different from the other kind of mistake.
Well, trying to turn the steering wheel back into the climate policy and away from monetary policy. Last question, and then we're going to take audience questions. You said we can go to 25? Okay, we're good. Perfect. We're going to go a little long. So my last question for you, which you touched upon, is you think about the importance of finance in thinking about the climate transition and the role in domestic policy or government policy, but also importantly the role of international bodies. Yeah, as you started and you repeated, I mean, climate change is a global phenomenon. So what are the when we think about the finance of the transition, what are the domestic elements we have to get right, and what are the international components?
Sure. So let me begin with the international, because we haven't touched on that so far. And as you said, climate change is a global phenomena. It's a global public good. And that means we have to have everybody in the world cooperating. And yet there's an enormous free rider problem. I think there's less of a free rider problem than we sometimes think, because I'm of the view that taking strong climate action can actually be good for the economy for reasons we talked about. The co-benefits, the cost of renewables have come down. You get onto the learning curve of the new technologies, and so I actually think that for most countries, not for Saudi Arabia, for most countries, a greener policy is actually a better policy for their citizens alone, let alone for the global economy. Even more so as countries like EU are imposing penalties in one way or another on others that do not adhere to certain climate policies, cross-border taxes, regulations on the importation of palm oil that's grown on deforested land and so forth. So, but one part of other countries' response is access to finance. One of the things about the green transition, even that we've talked about a little bit, even if it's more efficient, it may require more upfront money. Putting the solar panels is a good idea if the interest rate is low. But unfortunately, for developing countries, interest rates are very high. And so they face the dilemma: do I spend money on greening the economy or on education or other things for promoting their growth? And this is where I think the international community, in one way or another, it is in their self-interest to make access to finance at reasonable interest rates available. The multilateral development banks, and the IMF, are now pretty committed to it, but they're undercapitalized. Until very recently, the head of the World Bank was a climate denier, so he was a denier that he was a climate denier, but everybody knew that he was a climate denier, and so it didn't give impetus to the bank to do what it should. But the new head is very committed to that agenda. one has to understand that the interest rates they face make it very difficult for them to do it. And so I think this ought to be a first order. And you understand the interest rates have to do with country risk versus, they're paying a country risk premium. And that's particularly true in Africa, but either in other, in Brazil, the interest rates are very high. There are market failures in some of those markets that just make access to finance very difficult. Now, let me bring it back home and to the United States. There's a little bit of the same problem I talked about it. Homeowners can't get access, and I gave a solution to finance at reasonable interest rates, and I gave an example of how we might provide more access to finance. The big question, if you go to international meetings like the UN General Assembly, the meetings around the UN General Assembly a week ago, everybody's talking about green finance. And there is a big debate about green bonds, taxonomies of telling what. So there's a big debate about what is the additionality, is more money going there, and to what extent this is greenwashing. And a good area of research is, I've always believed that if you talk enough about climate, it actually affects people's behavior. But that's a question in behavioral economics that is still open. I think a lot of young people want to be part of a company that is part of the solution to the climate change problem, and so they're pushing the companies and having that public face of doing something about it. They will help hold the company accountable. I wonder, I guess I think it's a good area of research is the extent to which green bonds lead to that much additionality for finance. But what is perfectly clear is that there is a big need for more finance.
Perfect. So let's see. I think we have time for a question, right? Then there's a microphone right behind you. And say who you are and affiliation. Is that what, Doug? Yeah.
Professor Stiglitz, Titus Pierce, the sole proprietor of Royal Bank of America. Professor, we are a highly litigious society. You've insinuated that the Department of Treasury could potentially lend as a middleman straight to the public, consumers and businesses, low end 1% to 3%. As a banker, I'm a born banker. I've been at the bank since I've been 16 years old. Part of the way we make money, almost all of the way we make money, is deposits, loans, and trust. So you would be taking out a huge component of the banking balance sheet. The income and due that we would receive would all be going to the Treasury Department. Now, the very next thing I want to say is, when you make a loan to a consumer or a business and there's a covenant, they sue us a lot. Well, you really can't sue the federal government. So you're talking consumers and businesses whenever there would be a hiccup in a loan or some level of credit facility all over the country. You're talking maybe 400,000 government employees and underwriters. That's like insane considering that banks are prepared for that. That's exactly what we are by congressional mandate. Do you have anything to say about that, Professor?
Oh, that was the question at the end. I knew there was a question at the end. We'll take, tell you what, we're so low on time. We have one question over here, nobody. Okay, there you go.
So let me begin by an analogy. In Australia, the government provides income contingent loans and to everybody, and to all the students for universities. And they're better than the private sector because they're income contingent. They have the information, so you don't have to fill out a form or anything. They know what your income is because you put it on your income tax. And if you lie, you're liable for all kinds of penalties. So, there was a story about somebody coming to Australia and saying, you know, how many people do you need to administer this system? And he said, 17. And he said, oh, you mean 17,000? That's very impressive. And he said, no, 17. Why? Because it's just a line in the program of your income tax. You fill it out, and everything else is computer. It's automatic access. That is to say, if you're enrolled in a university, you automatically get access, and they know what the tuition is. Now, this is a little bit more complicated, but if it were a loan for the installation of solar panels for home heating connected to the grid, the people who you might have to have, it would be more certify who are solar panel, you know, that you actually did this, but we have that as part of our income tax system already. So if you do engage in a certifiable action, and if you don't, that's again criminal liability. It would not be very hard to enforce. Now, you say it would undermine the banking system, or those people who are making those loans. That's true of every productivity increase. The electric car, the EV car, is going to create a lot of unemployment in the car repair industry. That's not an argument against the EV. It's an argument for the EV. It's an increase in efficiency. Now, responsibility of macroeconomic policy is to make sure our economy is strong enough that it will absorb those people. So those bankers who are currently vetting all those loans and who made billions of dollars in the during the COVID-19 lending that was delegated to them, and were exposed to all the corruption in that lending process, they won't have a job. I mean, my heart is out to them. But in the name of efficiency, I think it's a good thing.
On that note, I think it's just in time to finish. Thank you so much. This is terrific.
So, unsurprisingly, this has been a thoroughly fascinating and provocative conversation. We'll take a very short break now of 7 minutes, so look at your watch, add 7 minutes. But please join me again in thanking Joe and John for their discussion today. Sorry?